Good morning, everybody. It's a privilege to have you, so many entrepreneurs and investors as the audience. And to begin with, on the investing side, may I begin with Dhanpal? Dhanpal, you are a private equity fund and you look for investments in companies. So, what are your criteria for investments? If you can throw some light on that.
Thank you, Bhavesh. Very good morning. Broadly, I think one, as an investor who's focused on India, clearly we are broadly long India. Why is that? Because of the economic opportunity that India provides. Secondly, within the economic construct, one of the key areas where we've seen long-term secular trends is domestic consumption. Domestic consumption forms 2/3 of this economy. Close to about 62% of the country is driven by domestic consumption, and that's everything you can think from loans to phones. Consumer services, products, financial services, telecom services, etc. So I would say there are several, key criteria, consumption, the sector itself, then comes down to the company itself. So I would say at macro level, there are lots of issues, but on a micro basis, at the company level itself, I would say the key elements around there are three. The quality of entrepreneur, the quality of the business, and the timeline over which the opportunity is there for business to grow and either double or triple itself.
Thanks, Dhanpal, for that. A lot of investors say that companies are raw, and one of their value adds is to bring in corporate governance systems. But now that is becoming the criteria for investments to become. So, Mark, what is your view on that?
When it comes to India per se, I think India in private as well as in public markets, it's kind of a market where you need to pick stocks. Actively, the focus on the company. The sector, of course, is important, but the focus on the company is, I think, of paramount importance. And therefore, the management team and how cohesive they are, how long they've worked together, what kind of results they've had in the past, etc., is key. Coming to the corporate governance aspect, I think I have a rather broader view of governance in general, not just corporate governance. And I think it's important when we're looking at an investment to assess how the company and the management deals with all the stakeholders in the business. So not just the shareholders, not just the board of directors, etc., but their customers, their suppliers, the government, when I say the government, including the taxman. And I think assessing how transparent and fair the company and management is in dealing with all those stakeholders is of paramount importance, because you're entering into a partnership when you do a private equity transaction. It's a long-term relationship with the company and its management. And there are numerous studies out there which show you that well-governed companies, investors will pay premiums of up to 30–40% to enter a business where the governance standards are high. So there is a very, very clear reason why governance is important. It's not just paying lip service to the idea, but actually creating value because governance is good.
Thanks, Mark, on that. One point over there which you mentioned is the investment is a long-term investment. It's a relationship. So it boils down to personal equation. Sanjiv?
One of the entrepreneurs mentioned that, P could be better in terms of providing value add. And the other entrepreneur mentioned that, he was completely indifferent to the PE investor. Who is that PE player? Who's going to be your financial partner? Don't look at him as a mere investor. He is your financial partner. Maybe the journey is for 3 years, 5 years, 7 years. But during that journey, treat him as your financial partner. We prefer to walk away from a deal if we don't have a personal chemistry with the entrepreneur. Even if that business is a great business, we have enough experience. We have made over 65 investments in India. We have exited from 40 of them. If you, at the outset, know what is the value add that the PE brings to the table, you will have much pleasant, much more fruitful, much more value-added relationship. And the same goes for the even PE player.
Well, thanks, Sanjiv. Right? Investors have to go through a sectoral analysis, find the smart investors. Companies have to come back, get the chemistry right, set expectations right. So Dhanpal, why do a PE? Why just not go for an IPO?
Entrepreneurs essentially spend an inordinate amount of time focusing on extracting maximum value. What is the price? And it's kind of a buyer versus a seller who's going to be basically, is a negotiation process. And in that entire negotiation process, an inordinate amount of time is spent trying to find the price, generating earnings, generating higher sales, customers, whatever you're trying, acquiring markets, new products, adjacencies, etc. So if there's such a long journey where someone is going to be, as a partner, in bed with you, you're basically just seeking to maximize price at the time of the entry, the process is not necessarily pleasant all the time.
In the private equity world, you go out, you contact, if it's a banker involved, they'll tell you they'll contact 15, 20 investors, and then you're doing a deal at the highest price. So it's not an average price. So you're already setting the expectation so high because there's no process of book building in the private equity world.
Sanjiv, given now that we want to go for a private equity, how easy or difficult it is to kind of get the deal done? I mean, one of the issues is valuations. The other issue is in terms of setting expectations right. But in general, do you see good quality companies coming? My question to you is more to do with the fact that we've seen a lot of investments happen in the last 6 years. There was an exuberance of investments in 2007 or early 2008, and then there was this global financial crisis. Investors haven't particularly made money. So the investments are now coming back on track. But do you see investors now becoming more and more demanding in terms of what they expect from the companies before they invest? You want to reflect on that?
You're looking at growth capital. Private equity is risk capital. And the dichotomy is that entrepreneurs like yourselves, when you seek private equity, you want to pass off some of your risk burden to the private equity player. So you're very clever. And the private equity player is a foolish guy. Because he thinks that he's providing growth capital, little realizing or probably not getting the risk capital aspect built into or factored into his valuation, the point that Mark alluded to. But the right way to go about it is if the entrepreneur and the private equity player both look and converge at a concept of smart capital. Private equity is no longer going to throw money at entrepreneurs. That era is over. PE in India is a minority stakeholding. At best, most of the deals are around the 10-20% of the equity. All what we hold is a piece of paper. You run the company. So tomorrow, if you want to basically, screw up, I mean, the company gets screwed because of your problems, but the PE money, the risk capital goes down the drain. So that is something that I would beg the entrepreneurs to understand and appreciate, that it's not necessarily the highest valuation that is the most attractive, but look at the kind of value add that you're going to get from a financial partner. Not many entrepreneurs pay enough weightage to this concept of value add. So understand, PE is not a bank. PE is bank plus smartness. And that's what we call smart capital.
I have one last question for all three of you. And this is pertaining to conflict management. And when I say conflict management is once you've invested, is the short-term versus the long-term goals. And this was, in fact, one of the discussion points in the earlier sessions. the PE investors have a finite horizon of 5 years or 6 years when they have to exit. So they want to make sure that the company numbers are good by that time when they're exiting. However, the company might require more investments from a longer term perspective. So how do you resolve this conflict, how do you come across that?
PE and the entrepreneur are on the same page. At the end of the day, as long as there is clarity of understanding, as long as there is clarity of, how the exit will take place, when it will take place, you can always plan. So at the end of the day, as long as the focus is on the business, there is no conflict between the entrepreneur and the PE. It's only when there are misplaced interests that conflicts arise.
I think, whether you call it conflict, whether it's a kind of a, resolution, issues management, whatever it is, this is a part and parcel of any journey. It starts, whether you call it fortunate or unfortunately, at the beginning itself, when you enter into some very, very long list of kind of agreements between you and the PE investor on what you will and you will not do. There's clarity in terms of purpose, what we are trying to do as partners together. And at least there is clarity in terms of if there are issues, how issues basically one gets surfaced and resolved between the partners. And then it's I think Sanjiv's made a very valid point. At the end of the day, it is all about the business, because a PE investor comes in with the expectation that the business will do well and that performance will generate returns for him as he exits the business 3-5 years hence.
I think it's basically, if the relationship has gone well, then the entrepreneur is as interested in you making a profitable exit as you are. If it hasn't gone well, then this is not the only conflict that's arisen. There'll be loads of them that you have to deal with. So,
No, thank you so much for airing your views.